Hi, and welcome back. We're going to talk about incorporating. Should you incorporate or should you not incorporate? Did you incorporate and should you have not incorporated? There's a grand old myth here in the country. It goes from coast to coast, and the myth is carried on by accountants and lawyers and consultants, and it's the old sacred cow that everybody believes in. And I'll say it and you'll know it. Why? With incorporations you have less tax and less liability. Well, hello world, that's bull. You have more tax and more liability. And let's just start off with the fact that we have one Income Tax Act. It governs sole proprietors, persons, and corporate persons, aka incorporated companies. So, same act. However, there's hundreds of laws in the Income Tax Act that govern corporations, but don't govern sole proprietorship persons. Now, if you don't know what those laws are, and you believe, as I believe, the greatest fear in the world is the fear of the unknown, I got to tell you, that's one unknown that you better get known about, and there's oodles of liabilities that you can be facing, and responsibilities, and traps, and old myths about what you're going to do as a corporation to save money. There's also the Corporations Act. It also has hundreds of laws that you're supposed to follow. So you better think about those hundreds of laws and ask yourself, do I know those hundreds of laws? And you probably don't. And do I want to hire a lawyer to look after me as I go down this path? And the answer is, of course you do. You need a corporate lawyer, a tax lawyer, a human resources lawyer, you need a constitutional lawyer, you need an employment lawyer, and a public servants lawyer, et cetera, et cetera, et cetera. The laws in this country are huge, and you've just opened yourself up. And also there's Canada Revenue Agency has a special department for dealing with corporations. They're much more likely to go after you. So that's the beginning of the liability. Now people think that, oh, if I've got the corporate veil, I can hide behind that. Well, yeah, you can get out of most debts. Unless, of course, you had to personally sign for those debts, which in most cases you did, or the corporation had enough assets that you didn't need to personally sign, but you own the shares and those are your assets and they're vulnerable. And you're still vulnerable for source deductions. In other words, wages, the income tax you're supposed to deduct from your employees. You're still liable for the HST, and they're considered trust funds, and the corporate veil doesn't protect you. And CRA will hold you as directors accountable for that. And there's all kinds of special punishments for you, by the way. So when you look at it and you say, anybody with half a brain in their head has an issue with the corporation, they also sue the director as well. So now you have to pay for two legal defenses, the corporate legal defense and your personal legal defense. So, and here's how it works. You better have liability insurance, and because if you lose personal or corporately, you need to have that covered. But then, of course, there's the problem. If you didn't do your due diligence, then you're not protected by the corporate veil, and you're personally on the hook. If you did your due diligence, it doesn't matter whether you're incorporated or not, because you've got a due diligence defense and you win. So you didn't need the corporation. So all the corporation did was run your expenses up, and you're still vulnerable. And you shouldn't borrow money that you don't intend to pay back anyway. So going down the road, you say, oh, well, if it protects me from certain debts, and I'm planning on having these debts that I'm not going to be able to pay off, maybe you shouldn't even incorporate. So you save yourself that aggravation. Now let's talk about less tax. Yeah, corporate tax rate is invariably lower than the personal tax rate. But let's just look at that for a minute. That only matters when you are planning on leaving money in the company as retained income. Sooner or later, you're going to want to take advantage of that money, either in benefits or in money. So that sooner or later, when you take the money out of the corporation, which is now after-tax dollars, you have to pay tax on your marginal tax rate. So I'm going to hit that point really hard. I want you to listen to this. You made $1 gross. The corporation paid 25 cents on that dollar. You're left with 75 cents. 25 cents is gone. Now, you get back, so you take out $75, 75 cents, and you add that to your income. You're going to pay 38 cents tax on that. So add 38 cents and 25 cents, and you're at about 55% tax rate. That's a higher tax rate than if you're incorporated. So that you pay less tax is bullshit. Now let's look at it and you say, but there's dividends. Yeah, there's dividends. But read Bill C-160, where they explain the reason for the markup is so that the person who receives the dividend pays tax at their normal marginal tax rate. In other words, so that it's marked up so that you pay the full amount of tax. The dollar dividend comes, you mark it up to $1.38, you get the tax, you get down to what you would have paid in the first place. It's explained in Bill C-160. Most people don't stop to think about that. And if you do the math, you will find out if you issue a dividend, you're going to pay 1% more in tax than if you just paid yourself. Now you have to pay the accountant to do all this stuff. Your corporate bookkeeping is onerous. It costs way more money to do your bookkeeping when you're incorporated than if you're a sole proprietorship. It costs way more money to do your taxes. There's a way more scrutiny. So it's damn tomfoolery to think that incorporation is some magical thing. You can do anything as a sole proprietorship that a corporation can do. So having said that, is there ever a reason to incorporate? You betcha. There are, many of them. But it doesn't include saving taxes or less liability. Thank you.